Welcome to FinSights Daily by Finvestin, where we cover the daily updates from the world of finance that impacts your day-to-day life. I'm your host Narendran. Quick reminder, play this episode at 1.5x for a better experience if you are short on time. In the first segment, let's talk about the escalating trade war between China and the United States. Today, China retaliated against President Trump's tariff hikes by imposing a hefty 34% tariff on US imports. This move follows earlier measures like a 15% tariff on coal and liquefied natural gas products and a 10% tariff on crude oil and agricultural machinery. These tensions are not just affecting global trade, but also triggering fears of a worldwide recession. For India, this could mean increased volatility in markets like Nifty, which recently closed below the critical 23,000 mark. Now, what does this mean for the average Indian investor and consumers? Let me break it down for you. First, the rupee could face pressure as global uncertainty rises. If you are planning for foreign travel or have dollar denominated expenses, you might want to plan accordingly. Second, sectors heavily dependent on global supply chains like electronics, automotive components, and pharmaceuticals could see disruptions and potential price increases. Third, Indian exporters might find new opportunities as American buyers look for alternatives to Chinese products. This could particularly benefit our textiles, chemicals, and engineering goods sectors. But there is also a silver lining for India. As multinational companies adopt a China plus one strategy, India stands to gain if we can seize this opportunity to attract foreign investments. The key takeaway, while global trade wars create short term volatility, they also reshape supply chains and create new opportunities. For retail investors, this might be a good time to review your portfolio allocation and ensure you are adequately diversified. Gold ETFs surge amid geopolitical tensions. Now, onto a brighter spot in these uncertain times, gold ETFs. Amid rising geopolitical tensions, gold has once again proven itself as a safe haven for investors. In February 2025, inflows into gold ETFs surged by an astounding 98.54% year on year to 1979.84 crore rupees. Why are investors flocking to gold ETFs? Unlike physical gold, these funds offer liquidity, transparency, and ease of trading. No worries about storage or purity issues. With gold prices climbing steadily, this trend highlights how Indian investors are adapting to safeguard their wealth during turbulent times. Let me share some numbers that illustrate just how significant the shift is. The assets under management for gold ETFs have crossed 33,000 crore rupee mark as of February end. This is a historic high. And it's not just institutional money. Retail participation has grown by over 40% in the last 6 months alone. For those of you wondering if it's too late to consider gold in your portfolio, here's something to think about. Gold has historically performed well during periods of geopolitical uncertainty and high inflation. With both these factors currently in play, many analysts believe gold could continue its upward trajectory throughout 2025. But how exactly do gold ETFs work? Think of them as a simple mutual fund units. You can just buy one single unit of gold ETF for every penny you pay. These ETFs are traded on gold stock exchanges just like shares, making them convenient for retail investors. The minimum investments can be as low as the price of one unit, typically around 4,500 to 5,000 at current gold prices. And the best part, you can start with as little as one unit and add more over time through systematic investment plans. If you are considering adding gold ETFs to your portfolio, remember to maintain a balance. Generally, I recommend allocating 5 to 15% of your portfolio to gold depending on your risk appetite and your financial goals. And finally, let's talk about reforms closer to home. The Employees Provident Fund Organization EPFO has introduced two key changes aimed at simplifying claim settlements for its members. First, members no longer need to upload images of checks or attested bank passbooks while filing claims. a move that has already benefited over 7.7 crore people since its pilot phase. Second, EPFO has removed the requirement for employer approval after bank verification for seeding accounts with UAN. These reforms are expected to enhance ease of living for members, making process more efficient for employers. What does this mean in practical terms? Let's say if you are changing jobs and want to transfer your PF balance to your new employer's account, previously the process could take few days. Now it will take just few hours. Consider retirement scenarios as well. When you are ready to withdraw your accumulated PF amount, the streamlined process means faster access to your hard earned money without unnecessary bureaucratic hurdles. For those of you who haven't linked your Aadhaar with your UAN, now might be a good time to do so as it further simplifies verification process and enables faster claim settlements. That's all for today. From global trade wars to gold ETF surges and PF reforms, we have covered developments that impact your investments, savings, and financial planning strategies. Remember, in times of uncertainty, staying informed is your best defense. This is Naren signing off. I'll see you in next episode with fresh updates from the financial world. Have a wonderful evening and remember, stay financially savvy.